Index numbers part 3. Nifty, also called Nifty 50, is the market index consisting of 50 well established and financially sound companies listed on National Stock Exchange of India NSE. The base year of Nifty is taken as 1995. Hermann Paasche, German economist Hermann Paasche, 1851 to 1925, developed an index for measuring current price or quantity levels relative to those of a selected base period. Paasche's index uses current period weighting. Limitations of index numbers. Index numbers are useful in practice. However, they suffer from certain limitations. Therefore, they are not completely reliable. First, based on samples. Index numbers are generally based on samples. We cannot include all the items in the construction of the index numbers. Hence, they are not free from sampling errors. Second, bias in the data. Index numbers are constructed on the basis of various types of data, which may be incomplete. There may be bias in the data collected. This is bound to affect the results of the index numbers. Third, misuse of index numbers. Index numbers can be misused. They compare a situation in the current year with a situation in the base year. Hence, a person may choose a base year which will be suitable for his purpose. For example, a businessman may choose a year in which his profit is high as the base year and show that his profit is falling in the current years. Fourth, defects in formulae. There is no perfect formula for the construction of an index number. It is only an average and so it has all the limitations of an average. Fifth, changes in the economy. The habits, tastes and expectations of the people in a country are always changing, and all these changes cannot be included in the estimation of index number. Sixth, qualitative changes. The price or quantity index numbers may ignore the changes in qualities of the products. At any given time, a better quality commodity will have a higher production cost and a higher price than an ordinary commodity, which is a substitute for the better product. Seventh, arbitrary weights. The weights assigned to different commodities may be arbitrary. Eighth, limited scope. An index number has limited scope because if it is constructed for one purpose, then it cannot be used for any other purpose. National income. Introduction. National income is one of the important subject matter of macroeconomics. The national economy comprises of all the firms and factories, shops and markets, bank and financial institutions, various departments and their offices, etc. National income is a composite measure of all economic activities such as production, distribution, exchange and consumption, but is also an objective indicator of economic welfare of the people in a country. In India, establishment of the National Income Committee NIC in 1949 marked the beginning of government efforts for regular compilation of national income estimates. At present, Central Statistical Organization CSO compiles and publishes data on national income and allied aggregates every year, meaning modern economy is a money economy. Hence, national income of a country is expressed in terms of money. The total income of the nation is called national income. In real terms, national income is the flow of goods and services produced in an economy during a year. Definitions of national income. Following are some of the important definitions of national income. First, National Income Committee. The National Income Committee was appointed by the Government of India in August 1949 with Professor P.C. Mahalanobis as chairman and Professor D.R. Gadkil and Dr. V.K.R.V. Rao as the members. According to NIC, a national estimate measures the volume of commodities and services turned out during a given period counted without duplication. Second, Professor A.C. Pugh. National dividend is that part of objective income of the community, including of course income derived from abroad which can be measured in money. Fifth, Professor Irving Fisher. National dividend or income consists solely of services as received by ultimate consumers, whether from the material or from their human environments. Features of national income. First, macroeconomic concept. National income represents income of the economy as a whole rather than that of an individual. Hence, it is a macroeconomic concept. Second, value of only final goods and services. In order to avoid double counting in national income, the value of only final goods and services produced in the economy are considered. The value of intermediate goods or raw material is not considered. For example, while estimating the production of shirts, there is no need to take the value of cotton as it is already included in the price of the shirts. Third, net aggregate value. National income includes net value of goods and services produced and does not include depreciation cost, which is wear and tear of capital assets. Fourth, net income from abroad. National income includes net income from abroad, which is difference between export value and import value, and net difference between receipts from abroad and payment made abroad.